We shall commence this module by discussing about the demand for money, nominal and real cash balances. Money is an asset for general public excluding the producer of money and hence has a demand for it, a supply of it from its producers, that is the government and the banking system whose liability it is, and a market of it which is comprising of these demanders and suppliers of money. The demand for money is the keystone of monetary theory. Since money is a stock of variable, we refer to its quantity at a point of time. As an asset, the demand for money is the public's demand to hold whatever be the motive for holding it and whatever be the length of time period for which it is held. The demand for money here is an aggregate demand by the individual members of the public, households and firms. Related to this is the question of why does the public demand money and what are the determinants of public demand for money. Here is the important to distinguish between the concepts of nominal versus the real cash balances, where the cash balances is another term for money. Nominal cash balances are the money of the current purchasing power of a unit of money, say a rupee or a dollar. A nominal rupee will nominally always be a rupee, but its purchasing power in terms of real goods and services can vary from time to time with changes in the general price level. For making the real value comparisons, we need to choose a reference point or a base year, say 1990 to 91 can be chosen as the base year with the wholesale price index number which is equals to 100. The rupee in that year had a certain amount of purchasing power at the price prevailing during the year. If in the year 2011 and 12 the average price index number rises to 400, then the purchasing power or the value of the rupee falls by 1/4 of its value in 1990-91. A real cash balances are money of some base year purchasing power. They are given by the nominal cash balances deflated by the price level. That is, if M and P are the nominal money and price level index number, then the real cash balances are given by M by P. This is measured in terms of the purchasing power of money in the year which serves as the base year of the price index number P. In the analysis of demand for money, the question of whether the public wishes to hold some nominal quantity or real quantity is important. This would also make P one of the important determinant of the nominal demand for money. After studying this module, you shall be able to know about the different definitions of demand for money, learn about the different approaches or theories of demand for money, identify the determinants of demand for money function, evaluate the relative merits and demerits of the various approaches, analyze the structure of the demand for money function. Let us begin with the theories of demand for money. First is the Neoclassical Theory. The early Neoclassical theory of the demand for money is attributed to the Cambridge economist Marshall and Pigou. The Cambridge approach postulates the following demand for money function: MD is equals to KY, where MD is the amount of money demanded, that is stock at a point of time with no time dimension. Y is the money value of the national income, that is given as flow per unit of time per year, which is also equals to PY, where P is the general price level and Y is the real national income. K is called a Cambridge constant representing the demand for money per rupee of income, per unit of time or the proportion of money income the public likes to hold in the form of money. It has the dimensions of time. This means that MD is equals to KPY. This is given as equation 1. Speculative demand for holding money. In this analysis, superscript naught represents the present and 1 stands for the future. Derivation of MR in 2 steps. Step 1. We consider a high rate of interest in the market today. A high rate of interest implies P naught, that is prices of bonds, to be low, which further implies that P1B, that is expected prices of bonds, to rise in future. Rise in pi E naught, that is expected gain, which is given by PB to the power 1 minus PB to the power naught from holding bonds today, is equals to DB naught, that is the demand for bonds today, is equals to the households prefers to hold bonds rather than hold money for speculative purposes, is equals to MR1 to the power naught falls. Thus, when rate of interest today is high, then MR naught today is low. Similarly, for a low rate of interest, RC to the power naught low is equals to PB to the power naught rise is equals to PB to the power 1 fall is equals to pi E to the power naught fall is equals to DB to the power naught fall. This implies households prefer to hold money rather than bonds is equals to MR2 rise. Deriving MR function, a rise in R to the power naught H implies a fall in MR to the power naught. Step 2. It is necessary that there be some differences in expectations. In any asset market, there would be some bulls and some bears. Therefore, at each point A or B along the MR function, there would be some investors prepared to buy bond at the highest price and some who wish to sell at the lowest price. This gives rise to the difference in expectations. Hence, at each point along the pi E MR function, we do not face an all or none opinion. On the other hand, at each point there is a continuous decline along the MR function. This market is convex to the origin. The key feature of the Cambridge equation makes the demand for money a function of only money income. Here Y represents the money value of transactions carried through money. If the transactions are denoted by T with an average price PT, the total money value is PT into T. Here money is demanded as a medium of exchange and it provides a convenience yield and depends on the public's income and wealth and the rate of interest. However, over the short run, these are assumed to remain constant and determine the level of K at any time. Since data are available on Y and it provides a better behavioral explanation of MD, this version is used. If we divide both sides of equation 1 by P, then we get M by P to the power D is equals to KY. This is represented as equation 2. This gives the demand for real money and makes MD by P a function of only of Y with no other influence like that of the rate of interest. In these equations, K is a factor of proportionality. In equation 1, MD is a proportional function of both P and Y. This has two important implications. One, the income elasticity of demand for money is unity, and second, the price elasticity of the demand for money is unity, or MD is homogeneous of degree 1 in P, so that any change in P will lead to an equal proportionate change in M. Next is the Keynes theory of demand for money. At the outset, interrelated questions need to be separated. First, why is money demanded? And second, what are the key determinants of demand for money? The answer to the first question is that though money does not earn any income unlike other competing non-money financial assets, its holders enjoy a convenience yield of a non-pecuniary nature because money has the unique characteristic of being generally acceptable as a means of payment and so being perfectly liquid. Keynes attributed three motives to the demand for money. First, transaction, second, precautionary, and third, as speculative. The transaction motive gives rise to the transaction demand for money or cash by the public for making the current transactions in a money exchange economy where money is the medium of exchange. The precautionary motive of demand to hold money is to meet the unforeseen contingencies or uncertainties of all kinds requiring sudden expenditure. The speculative motive gives rise to the speculative demand for money or cash over and above that demanded due to the other two motives in the face of interest earning bonds and other financial assets. Holders of speculative balances or cash may anticipate such fall in future bond prices that the loss of foregone interest earnings look relatively smaller and they switch into bonds when the anticipated fall in the bond prices have been realized. Let us now understand the determinants of the demand for money. Keynes made the demand for money a function of two variables, namely income, that is Y, and the rate of interest, that is R. Keynes retained the influence of the Cambridge approach to demand for money under which MD is hypothesized to be a function of Y. However, this explained only the transaction demand and the precautionary demand for money. It is through the speculative demand for money that he made the demand for money a declining function of the rate of interest, which is a purely monetary phenomenon and the sole carrier of monetary influences in the economy. The speculative demand for money arises from the speculative motive for holding money. Keynes assumed that perpetual bonds are the only non-money financial assets in the economy which competes the money in the asset portfolio of the public. Though money does not earn any interest income, but its capital value in terms of itself is always fixed while bonds holders get interest income, which however can be wiped out if the bond prices fall in future. The bond prices is an inverse function of the rate of interest. When bond prices change, the bond holders are subject to capital gains or losses and they also get a rate of interest per year. The market rate of interest is given to the individual at the time of making investment in bonds, but as the future rate of interest or bond prices change, there will be expected capital gain or loss which will have to be anticipated. There are two kinds of speculators: bulls who expect the bond prices to rise in the future and invest all their idle cash into bonds, while bears expect the bond prices to fall and hence move out of bonds into cash if their expected capital losses on bonds exceed the interest income from the bond holding. They therefore minimize their losses. Thus, the speculative demand for money arises from the bears who build up their cash balances to move into the bonds when the bond prices have fallen as expected or when they come to expect that bond prices will rise in the future. In the Keynesian model, all these expectations are assumed to be held with certainty, but it assumes that individual asset holder portfolios are pure, not diversified. The bulls are entirely into bonds and the bears are entirely into cash. However, to move on to the aggregate speculative demand for money, Keynes assumed that different asset holders have different interest rate expectations. Thus, at a very high rate of interest or a very low price of bonds, all may be bulls. Then, the speculative demand for money will be equals to 0. However, at a lower rate of interest or higher prices of bonds, some bulls will become bears and a positive demand for speculative balances will emerge. At a still higher rate of interest and a lower bond prices, some more bulls will become bears and the speculative demand for money will be higher. This shows that the speculative demand curve for money with respect to the bond rate of interest will be downward sloping. There is also the possibility of the existence of a liquidity trap when at a very low rate of interest the speculative demand for money becomes perfectly elastic, and it is this rate of interest that all asset holders will become bear, preferring to hold only cash and no bonds. No amount of increase in money supply can lower the interest rate further. The Keynes theory of demand for money can be summed up as follows. MD is equals to L1 into Y plus L2 into R. This is represented as equation 3. Here L1 into Y represents the transaction and precautionary demand for money, which are an increasing function of the level of money income. L2 into R represents the speculative demand for money, which is a declining function of the rate of interest, and this relation is not assumed to be linear. Some critics argue against this additive form of the demand function and have argued that even though money may be one asset, the motive to hold it may be many, and the transaction and precautionary demand may be interest elastic, while the speculative demand may also be a function of total assets, wealth or income along with the rate of interest. This gives the revised form of the Keynesian demand function for the money. MD is equals to L bracket Y comma R bracket close. This is represented as equation 4. It is hypothesized that MD is an increasing function of Y and a declining function of R. Another theory is Baumol-Tobins theory of demand for money. In this theory, it is assumed that an individual household and firm faces the following situation. A given income is received periodically. B, cash purchases of equal amounts are spread over time throughout the period. C, option of holding transaction funds in the form of money or risk-free income yielding bonds or non-money financial assets. D, given cost in exchanging bond for cash per transaction. Here, the problem of transaction demand for money is the problem of determining the optimum amount of cash the individual will hold. This can also be seen as the problem of minimizing the total cost of financing transactions. This cost has two components. A, interest foregone on the average of the cash balances held, and B, the transaction cost of buying and encashing bonds if a part or whole of the transaction funds is held first in bonds and then converted into cash in installments. Holding too much cash would mean the interest foregone will be too high, although the transaction cost in bond market will be low. And if too little cash is kept in hand and so bonds are bought and sold more frequently, the transaction cost in the bond market will be too high. The optimal amount of cash balances will be somewhere in between, and the following is observed. First, the optimal level of transactions cash increases with the total value of expenditures to be made during the period, it is found to be the square root of the total expenditures, implying strong economies of scale in the individual's demand for cash. And second is the optimum level of transactions. Cash varies inversely with the rate of interest. These results hold true only for large firms and organizations. Though for theoretical purposes, we can assume that micro results for an individual cash holder will apply at the aggregate level. Let us now discuss the Friedman theory of the demand for money. Friedman's theory of demand for money is partly Keynesian and partly non-Keynesian. It is non-Keynesian in that Friedman neglects the Keynes classification of the motives for holding money and the corresponding components of the demands for money. For classifying the key determinants of demand for money, he classifies the holders of money as between A, the ultimate wealth holder, and B, the business enterprises. He emphasizes the role of the money as an asset, and in this he generalizes the Keynes analysis of the speculative demand for money by treating the total demand for money as a part of capital or wealth theory, which is also concerned with the composition of the balance sheet or the portfolio of assets. This is because money is generally acceptable as a means of payment and yield a flow of services to its holder and is subject to the principle of diminishing marginal rate of substitution. Hence, other things being the same, the larger the money balances, the lower the marginal services yield of these balances relative to the yield of the other assets. The households are the ultimate wealth holders, and money, like any good, would have a demand, and this demand is for a quantity of real and not nominal money representing a command over real goods and services. Friedman's theory of the demand for money for an individual wealth holder is thus given as m by p to the power d is equals to f bracket y comma w comma rm comma rb comma re comma p to the power e comma u bracket close, where m, p and y are the real cash balances and income of a single wealth holder. W is the fraction of wealth in non-human form, that is the fraction of income derived from property. Rm is the expected rate of return on money. Rb is the rate of return on fixed value securities including the expected change in their prices. Re is the expected rate of return on equities including the expected changes in their prices. P to the power E is the expected rate of change of prices of goods, and hence the expected rate of return on real assets, which is unadjusted for the storage cost attached to the service of money. Therefore, the key determinants of this demand for money are: first, total wealth. This total wealth has to be divided among the various forms of assets and is like the budget constraint. It includes not only non-human or physical wealth, but also the human wealth, that is the present value of the expected flow of labor income. Income is used as a surrogate of wealth and includes property and labor income and is a concept of permanent income. Second, the division of wealth between human and non-human forms. Since total wealth includes both human and non-human wealth, Friedman assumes that non-human wealth can be converted into human wealth and vice versa under certain institutional constraints. The demand for money is a declining function of the non-human fraction of total wealth, as it is much easier to purchase and sell it compared to the human wealth. Third, the expected rate of return on money and other assets. The nominal rate of return on money may be 0 on the currency component of or negligibly small, but positive as in the case of demand deposit portion of the saving deposits, which is a part of money. The return may even be negative if there are net service charges on the current account deposits which earn no rate of interest. The nominal rate of return on other assets consists of two parts. First, any currently paid yield or cost such as interest paid on bonds, dividends on equities and storage cost on physical assets, and second, the expected changes in their nominal prices. This second part is similar to the expected gain or losses in the Keynesian speculative demand for money, where he had considered only bonds as the competing non-money asset or representing all long-term financial assets. Friedman extended the margin of substitution for money to the stocks of durable goods. For them, the expected rate of change of prices gives the appropriate rate of return, which is again important under the conditions of inflation or deflation. Fourth, other variables. Some other variables may affect the utility attached to the services of the money relative to those rendered by other assets. One of them could be the degree of economic stability expected to prevail in the future. According to the Friedman, wealth holders are likely to attach more value to liquidity when they expect economic conditions to be unstable than when they expect them to be highly stable. Let us now summarize what we have learned in this module. This distinction between real and nominal cash balances. Nominal cash balances are the money of the current purchasing power of a unit of money, say a rupee or a dollar. A real cash balance are the money of some base year purchasing power. They are given by the nominal cash balances deflated by the price level. That is, if M and P are the nominal money and the price level index number, then real cash balances would be given by M by P. This is measured in terms of purchasing power of money in the year, which serves as the base year of the price index number P. Theories of demand for money, determinants of the demand for money, the Neoclassical theory of demand for money. The early Neoclassical theory of demand for money is attributed to the Cambridge economist Marshall and Pigou. The Cambridge approach postulates the following demand for money function: MD is equals to KY. Keynes theory of demand for money. Keynes attributed three motives to the demand for money: transaction, precautionary, speculative. Keynes made the demand for money a function of two variables, namely income and the rate of interest, and the revised form of the Keynesian demand function for money is MD is equals to L bracket Y comma R bracket close, which is represented as equation 4. It is hypothesized that MD is an increasing function of Y and a decreasing function of R, that is interest rate. Baumol-Tobin theory of demand for money. Here the problem of transaction demand for money is the problem of determining the optimum amount of cash the individual will hold. This can also be seen as the problem of minimizing the total cost of financing transactions. Next is the Friedman theory of demand for money, which is given as M by P to the power D is equals to F bracket Y comma W comma Rm comma Rb comma Re comma P to the power E comma U bracket close.